stocks are experiencing difficulty in this environment as the market tries to understand how far the Fed is going to go and how deep this recession is going to be. So Tesla, as I mentioned, is a solution to the problem. It's very interesting. If you look at gasoline demand this summer in the United States, it dropped below COVID levels, the worst of COVID, and it dropped to levels that we have not seen since 1997. That's real demand destruction. And it couldn't have happened, we do not believe, without electric vehicles at the margin taking huge share from traditional automobiles. So if we had to be concerned about an industry, it would be the traditional auto industry. We think that gas-powered vehicles are going to be obsolete within the next 5 to 10 years, and the traditional auto industry has to figure out a way to migrate into electric vehicles and into the next big phase, which we think Tesla is leading, the autonomous taxi platform phase. So lots of changes here. Traditional industries are in harm's way as innovation pushes through, accelerated by some of the turmoil out there. Well, we are prolific users of Twitter. Ark gives away its research. We give away our research not when it's finished, but as it's evolving. And our most prolific platform, social platform out there, is Twitter. I'm kind of excited to see what Elon will do. I actually think he'll work closely with Jack Dorsey and maybe open up the ecosystem, take away the censorship, make it much more transparent, and I think add more value to that ecosystem. Interesting about Twitter, and we found this, we have a lot of debate around Ark's own strategies. We can filter that debate ourselves. So we can unfollow people if we think there's bad behavior, but that's our choice. And we can follow those people who we think are moving discussions, whether it's about innovation or the economy, moving discussions along. So I think there's a lot of wisdom out there, and we're kind of sick of the nonsense that we see on some of these social platforms. And Twitter, I think, is going to give us more tools to filter out the nonsense and get right down to business. And I think one thing that helps our clients is our research, and they see that it's first principles research. We have the long-term time horizon, and we're seeing spectacular exponential growth opportunities. And not only one by one, the various platforms I just described, but the convergence of those platforms. So one S-curve feeding another. And I think many of our clients understand that they're short innovation, truly disruptive innovation. If you own the NASDAQ or the NASDAQ 100 right now, and you look through that index, this is not the index that I grew up with. In the 80s and 90s, when we were looking for innovation, we'd go to the NASDAQ. But if you look through the NASDAQ now, and especially the NASDAQ 100, what you see are 25% of the names touching disruptive innovation. The rest of them are kind of me too. They look like other indexes, the FANGs, Microsoft, NVIDIA. Tesla would be our only overlap. And then you look further and more deeply into these indices, and you see names that you'd never expect to be there. Food and beverage, utilities, rails, brick and mortar retail. These are not innovation companies. And so what we've done at Ark is we are pure play innovation. And we'd like to think we are what the NASDAQ used to be in the 80s and 90s. And it used to be a very productive place to invest with a long-term investment time horizon. So I think our sharing our research and our pointing out to investors, look, what you think you own in innovation is not what it used to be. And what Ark is doing is really back to the future. We're all about investing in the future as opposed to indexes, which are more about past success. those companies that have been extremely successful have risen to the top of these indexes. But if we're right, in these 5 platforms that involve 14 different technologies are going to disrupt the traditional world order, then investors need to get to the right side of change. And one of the other things that we do, it's one of our missions and values, is to educate. That's why we give our research away. And we want to educate not only investors, but parents and grandparents about how the world is changing, how radically it's changing, and how it's ever more important to get especially students on the right side of change so that they can enjoy these incredible growth opportunities and not be disrupted by industries that will be sunsetting, shall I say. We have a 6-metric scoring system, very much focused on innovation. One of the scores is thesis risk. Thesis risk has a lot to do with government policy. And so in the early days of ARK in 2014-15, we were thinking, okay, government may be very concerned about the safety of autonomous vehicles. But as we've moved through these last 8 years, what we've seen, thankfully, is the government and regulators in particular very focused on data. And what does the data say? The data says that most fatalities and accidents, 85, almost 90% of them, are caused by human error. If we take the human being out of the equation, then we're going to save up to 35, 40,000 lives in the United States, the fatalities per year, and up to 1.25 million around the world. So that is a noble goal. And we've been very gratified to see the regulators looking at the fatalities in Tesla's vehicles and informing us that for the most part, most of those fatalities were caused by human error. And for the second, that people who are driving Tesla vehicles are much safer thanks to the various automated driving capabilities now, up to 40% safer than in most other cars. So we're very focused on what governments are studying in terms of the data. And if they stick to the data, innovation typically it solves problems and makes the world a better place. Well, if you look at what's happening in the pipeline, what you're seeing in terms of commodity prices are some very serious declines, both from their peaks and year over year now. So that is sort of, we would say that's upstream inflation that is heading towards the PPI and then ultimately the CPI. So we've got gold prices. And in fact, I looked at them yesterday. I had thought that the last 2 years, gold had been trading within the $1,700 to nearly $2,100 range. And that's true. It has, and it has broken down. This is a really good leading indicator of inflation. What caught my surprise yesterday was looking at where gold was in 2011. It was roughly this level. So you can say since 2011, more than 10 years, we haven't had a big burst, a big breakout in the gold price. And that is informing our decision here. Gold is a leading indicator of inflation, and it has not broken out. It is breaking down. And then the second thing that we're looking at is the inventory glut around the world. And especially in the United States, it looks like some of the best supply chain managed companies in the world have over-ordered. They ignored their automated enterprise resource planning systems, so ERP systems, and double-ordered, triple-ordered, so that Nike, for example, its sales were up only 3.5% globally last quarter, and yet its inventories were up 44%. And in the United States, they were up 68%. And if you look at in transit, they're up 85%. So that's just one indication. We're seeing lots of inventory overhangs, and even online sales are suffering. Amazon just had its second Prime Day, and it showed no increase, which is really from a year over year, which is telling us that either units are down or prices are down. So I think the CPI that we got today is a lagging indicator. It always is a lagging indicator. And we're seeing a lot of prices in the pipeline that are falling.